Vince is the owner of Vince's Deli. He has been operating his business out of his friend's kitchen for the last 19 months and would now like to move to a more marketable location. The owner of President's Square requested Vince to provide him with a complete set of financial statements for the year before considering him as a tenant in one of his vacant shops. Since Vince is more creative at heart, he never fully understood how to account for all the transactions in his business. You were provided with the following information in respect of the financial year ending 31 December 2014 that were not being taken into account. Vince had to pay rent for the kitchen. Let's just mark that so that we know exactly what year we're working with. Vince, and then they give us a lot of information. And eventually, they give us an analysis of the year's bank statements reflecting the following: deposits and payments. And then they give us, at the end of the day, a summary of balances. And obviously, that would be our opening balances, 31 December, and our closing balances, 31 December 2014. And there we have furniture, and there we have a number of question marks here for accumulated depreciation for equipment and accumulated depreciation on equipment. And then we have opening and closing balances for cash and cash equivalents, inventory, trade and other receivables after credit loss entry. We'll get there. Trade and other payables, and then capital with a question mark there. Now, you are required to prepare the statement of profit or loss and other comprehensive income for the year ended 31 December 2014. And also you have to prepare an extract of the statement of financial position for equity and liabilities as at 31 December 2014. Please see here that they don't require from you to do the note. They want you the actual statement of financial position, so the face of the statement as at 31 December 2014. Very important also, ignore all tax and VAT implications and comparative figures. So we don't have to worry about that. Yippee, yippee, yay. Good. Now, I would suggest when they ask you something like this, that you start with the template once more. You know exactly what a statement of profit or loss looks like. You know that you will start with sales and cost of sales. And you are supposed to read a question through a question once before you're actually going to start with a question. And there we see that inventory has been accounted for on the periodic inventory system. So we know that our cost of sales will be opening inventory plus purchases plus purchase-related costs less closing inventory. So you can write that down in your template. Sales less cost of sales then equals gross profit. You'll say other operating income. You will leave open 2-3 lines. You'll say other operating expenses. And as you go along, you can fill it in. The same thing applies to the B part of the question. You know what an equity section of a statement of financial position looks like. So we'll write the Vince Deli statement of financial position for the year ended 31 December 2014. Then you will start with equity, capital, opening balance, and that you can actually insert. There we have the opening balance, 9,000 Rand. You know that the other components of equity is additional capital contributions. You know that drawings is a number that can have an impact on equity, and then profit for the year. So you can write down the template in the meantime. Then liabilities, you know that you will have non-current liabilities. You can leave open a line or two, and then current liabilities. And as you go along, you can complete it with the applicable figures. Right, now let's start here at number 1. Vince had to pay rent for the kitchen in advance every month. Monthly rental amounted to 3,000 Rand. Now, if monthly rental is 3,000 Rand, how much rent should I have in my income statement? Obviously, 3,000 times 12 equals, there must be 0. 3,000 times 12 must be in total 36,000 Rand. So for that rent expense in my income statement, I know it's 36,000, I can plot it. If I pay a rent in advance, it's a prepaid expense. A prepaid expenses does not form part of liabilities, so therefore I do not have to worry about the prepaid expense. Now, if we're going to have a look at our amounts paid for the year, you will see that we have only paid 30,000 Rand rent for the year. So although they actually tell us that we are supposed to pay in advance for every month, it is very clear here that that was not the case which has happened during the year. We have paid only 30,000. We should have paid 36,000. So if we then take the 36 less the 30,000 that we've actually paid, we will see that we are a little bit behind our rent payments. So that is accrued expenses, and that forms part of trade and other payables. So you can prepare yourself a little note on trade and other payables so that you can accumulate in your note all the items that actually has a bearing on trade and other payables, of which one would be accrued expenses of 6,000. On 31 December 2013 and 2014, Spin still owed his staff R550 and R630 respectively in salaries. Now, the one that he still owes at the end of the year, the R630, that once more will be accrued salaries, which will form part of accrued expenses. So in your note, in your little calculation, you are going to add that R630. Now we have paid actually in salaries for the year 4920. So by reconstructing our salaries account, which reflects all the amounts that we owed, as well as all the payments for the year, we can now actually work out what was the income statement expense for the year. Now we're going to start obviously here with the amount still owed in the beginning of the year. So the opening balance on the credit side will be R550. Then the amount still owed at the end of the year, that will be a brought over balance on the debit side above the total line on the debit side, R630. We have paid, so bank was credited with 4920, so this salaries payable account of us would have been debited with 4920. So let's have a look what our salaries looked like for the year. Yeah, we paid 4920, less included in that amount was R550, which belonged to the previous year. And then for the current year, we still owe R630. So if we plot this information of the salaries in a T account, it's much easier to understand. Opening balance, it was owed, it was accrued, so it had an opening balance of R550. What did I do? When I actually, the first day of the year, I had an accrued account, I debited the accrued account, and I credited my salaries expense account, R550. Then we paid, in actual fact, 4920 for the year. There it was, 4920 salaries paid during the year, and we plot that in the salaries account, so we credited bank and we debited salaries. At the end of the year, the question tells me that we still owe R630 worth of salaries. There it is. So we have to increase our expense for the year with the R630, and the counter leg will be accrued salaries of R630. So at the end of the year, what happens to our salary expense account? Our salary expense account is being transferred to the profit and loss account, and that amount that will be transferred is a total expense of R5,000 for the year. So in our income statement, we can now actually go and plot under expenses, salaries, R5,000. And here you also see the rent for the year, R36,000, the 12,000 times the 3, the first additional point here, there's the 36,000. Okay. Vince allows his customers to buy pastries using cash or credit. One of Vince's long-term clients were declared solvent, and the balance on account, R2,500, should still be written off as a credit loss. So in the debtors account on the credit side, we're going to have credit losses written off R2,500, and then also in our income statement, we will have credit losses for the year of R2,500. For all the purchases of pastries and supplies, Vince paid a total delivery fee of R2,700 for the 2014 financial year out of petty cash. Now, if you go to payments, nowhere here we see delivery costs. Also very important that that delivery cost was paid for the purchases of pastries and supplies. So that is a purchase-related cost. So in our income statement, under purchase-related cost, we can now add delivery fee, 2,700 Rand. Then said returned pastries purchased to the value of 1320 that was stale when they arrived at his premises. Now what would our entry would have been? In our creditors account, we would have debited our creditors with 1320. We've already established that this is a periodic inventory system. So therefore purchases would have been credited with the amount of 1320. So if we reconstructed our creditors account, yes, our creditors account, we would have debited creditors with 1320 and we would have credited purchases with 1320. All inventory purchases were on credit, so that only confirms that that 1320 should be in the creditors account. If we go back, let's continue with this, then we'll do the payments and the receipts at the last. All inventory purchase were Vince already received his telephone bill on the 7th of the next month. The telephone costs incurred for the last month of the 2013 financial year, last year, amounted to 473 Rand and increased for the 2014 financial year. The monthly telephone costs remain constant for the financial year. The telephone account for December 2014 was still outstanding at year end. So last year we paid 473 Rand per month. This year we paid an increased amount per month. So what we have to establish, how much is the accrued telephone charges as at the end of December. When we go to our payments, we can see clearly that we have paid our telephone costs for the year of 5720. So 5720 was the total amount that we've paid. Included in this amount was the December 2013 telephone cost that we've paid of 473 Rand. Of 473 Rand. So that means that we have paid the amount of 5720 less 473, which belongs to the previous year, for the current year. How many months of the current year have we then paid if we take out the 473? We've only paid 11 months from January's bill up to the end of November's bill for the year. Now, if we're going to do that little computation, that means that we have paid on a monthly basis 477 Rand. So what is going to be our accrued expenses? Accrued expenses is going to be 477 Rand. And what is going to be our expense in our income statement? 477 times 12 equals an amount of 5724. So in our income statement, we are going to have an amount of 5724. Telephone, 5724, and then remember the accrued expenses, eventually we're going to add that to our trade and other payables, 477, the amount for telephone. Right. Depreciation must be provided as follows. Furniture at 20% per annum on the straight line method. Now, if we go to our payment schedule, we see that we have purchased equipment for the year, but we haven't purchased any furniture. So therefore, our furniture is straightforward. The cost price of the furniture was 7,600. We have to provide for 20% per annum on the straight line basis. So 7,600 times 20%. Give us the depreciation charge on our furniture of 1,520. Debit depreciation, which will be an income statement item, credit accumulated depreciation, but the asset side of the statement of financial position is not required, so you do not have to do that part. Now, what about the equipment? They tell us that equipment must be depreciated over its useful life of 10 years on the straight line basis. They tell us also that the residual values of furniture and equipment was initially estimated to be 0 and it remained unchanged at year end. So if we're going to have a look, what was our equipment? Now here we have purchased equipment during the year of 21,600. But obviously the first part would be on the 1,500 Rand. So that 1,500 Rand we have to depreciate over a 10-year period, and that equals 150 Rand. On the new equipment that we've purchased, which is 21,600 Rand, over a 10-year period, when did we buy this equipment? We bought it on 31 August 2014, so we have used it for a period of 4 months in the current financial year. So the depreciation charge on that equipment equals 720 Rand. So 720 Rand plus 150 Rand gives us a total depreciation charge of 870 Rand on equipment. And now you can go and you can plot that in your income statement as well. So year depreciation would be the total of, if you look at the note here, where we've calculated that, depreciation in total would be 2390. The 1520 plus the 150 plus the 720 gives us a total of 2390. If you did show that separately, it's not a problem, so it's 100% correct. Vince acquired a loan from FNB at 12% interest per year on 1 March 2014, so in the current financial year. The first installment to its repayment of the loan will only be on 1 January 2020. So obviously this would be a non-current liability, and you can go and plot that immediately on your statement of financial position. The amount that you've received as a loan is here under your bank deposits, 6,500. However, we have an interest commitment that we have to work out. How much was the interest commitment? So it's a 6,500 Rand multiplied by 12% per annum multiplied by 10 months, which will give us the total amount that we actually owed as interest for the year equals 650 Rand. And that is also accrued expenses. So you can add that to your accrued expenses as well, 650 Rand. If you go to our income statement, finance charges, there it is 650 Rand, which is my interest payable for the year. And then under my accrued expenses, we're going to have accrued finance charges or interest payable of 650 Rand for the year. Good. Now we can do the no adjustments were made to any opening balances. Good to know. Cash sales, 69,000 Rand. So in our income statement, we know that we have cash and credit sales, but we can, in the meantime, plot the cash sales. So the cash sales would have been, on the one side, 69,000 Rand. Obviously, we have to add some credit sales to that cash sales. Then debtor payments, 3,600 Rand. Well, now maybe it's time to open up all our other accounts with opening and closing balance. So let's do our debtors account, straight and other receivables. Opening balance 7,936, closing balance 10,580. 7,936, 10,580. Then our inventory. Well, this is a periodic system, so we can plot 1,700 opening inventory in our income statement because that will form part of our cost of sales calculation. Opening inventory there, 2,800, and closing inventory 1,700. Opening inventory, 2,800, closing inventory 1,700. Trade and other receivables, opening balance 7,936, closing balance 10,580. 7,936, 10,580. And then trade and other payables, opening balance 1,300 and closing balance 16,500. Opening balance 1,300, closing balance 16,500. So let's complete this puzzle that we have to build in order to get all the missing figures that we don't have. Debtor payments, 3,600 Rand. So this was a deposit, we debited bank, so we're going to credit our debtors account with 3,600 Rand. We've already spoken about the credit losses. Then capital contribution, 6,258. We can plot that in our statement of financial position. Directly, it was an additional capital contribution for the year, and that equals 6,258. Equity and liabilities capital, opening balance in the beginning of the year, capital contribution, 6,258. Then long-term loan of FNB Bank, non-current liabilities, 6,500 Rand. Long-term loan, FNB Bank, 6,500 Rand. The next one, interest. Now this is interest received of 9,620. Nowhere else in the question they actually refer to any interest, so we must assume that that was all the interest that we were entitled on. So under income, you can going to write interest received, 9,620. Other income, interest income, 9,620. Right, expenses, payments, creditors, 5,720. We've already opened up our creditors account, so there on the debit side, we will have bank 5720. Then we will have salaries we've already spoken about, rent paid we've already spoken about, telephone we've already spoken about, sundry operating expenses 3950. We can plot that down in our income statement, part of other operating expenses, sundry expenses 3950. And now we've actually handled all the deposits and payments that went through the bank payment. So what do we need? If we go to our income statement, we need purchases. And we know that purchases is also related to creditors. So let's have a look at our creditors. In our creditors account, we have the opening balance, payments made to creditors, we have the returns figure, which the opposite leg was in the purchases, and we have closing balance of 16,500. They tell us that all the pastries are being bought on credit. So that means that that amount, the balancing figure there, must be our purchases amount. So we balance off our creditors figure and we transfer the purchases to the purchases account. And now we can balance off our purchases account, and whatever is going to be the balancing figure here, we know that purchases are being closed off at the end of the year to cost of sales. So that 2920 will be the purchases figure in our income statement. So if we go to our income statement, opening inventory we had, purchases now 2920. 2920. Delivery fee we already have, closing inventory we already have. What we don't have is the other leg of sales. That one must actually be there. 69,000. Right. So the other one is the sales figure, the credit sales figure. Where do we get credit sales figure from? From our debtors account. So if we go back to our debtors account, we have the opening balance, we have the amounts received from debtors, we have the credit losses written off, we have the closing balance. So the balancing figure on the debit side of the debtors account must represent our credit sales for the year, 8744. So we have that figure. We all only have to do is to go and add that to our cash sales for the year, and the two of them together will give us the total sales for the year. So now we have sales, we've got cost of sales, and we can actually determine our gross profit for the year. Interest income we have, depreciation we have, credit losses we have, telephone, salaries, rent paid, and sundry expenses we do have, also finance charges. So we can work out our net profit for the year, which equals 6430. Once we have our net profit for the year, we can plot that in the statement of financial position. So under our equity section, net profit for the year, 6430, we can add them all together, and that gives us 21,680. We have our long-term loan, and all we have to do is to finalize our total trade and other payables. Trade creditors will be our closing balance in our creditors account, 16,500. Then we had accrued rent, remember, of 6,000. We had accrued salaries, not accrued. I do this all the time. I'm switching figures. Some symbols, accrued salaries 630 Rand, accrued finance charges 650 Rand, and accrued telephone 477. So total trade and other payables 24,257. We can now put that in our statement of financial position under current liabilities, a note number, a reference number plus the total 24,257. So total equity and liabilities 52,437.